There's a lot happening in real estate. Welcome to April Market Report, where we're diving into some big topics in housing and bringing it all home to San Bernardino. From the latest developments in the NAR settlement, which have dominated the headlines, to the essential factors impacting buyers today: inventory, mortgage rates, and affordability. To an overview of where owners stand in the market, we're here to guide you through it all.
At CGX, real estate represents more than just numbers. It represents freedom. Our mission to turn renters to homeowners and to help owners level up in commercial real estate is embedded in our fight against gentrification. In the Inland Empire, especially San Bernardino, ownership is key to making sure gentrification stays at bay. Good change is coming to San Bernardino, and the number one way to be a part of it is through ownership. So, whether you're an owner, whether you are looking to buy, or simply curious about the state of the market, we've got you covered. So, stay with us till the end.
Let's start with the NAR settlement. NAR is the National Association of Realtors, and if you haven't heard, they've been settling several lawsuits brought on by different consumer advocates. They settled for tens, if not hundreds of millions of dollars in total. And our trusted folks at KCM trust Brian Borrow's research, and he says our recent research at 1000 Watt tells us that consumer sentiment on this issue is malleable and volatile. People have just been blitzed with NAR agrees to slash commissions, headlines that may ignite mass consumer price sensitivity. And we'll pause there. We've been to many meetings, we've sat through several webinars, and have done our own analysis on the situation. And what he's saying is that the people's feelings about this topic can change a lot and quickly. So we come with facts and what matters. Our take is that nothing changes because of the lawsuit and settlement in terms of what matters. And what matters is the very valuable service that agents, both buyer and seller agents, provide for their clients. Commissions will still be paid, and how they're paid will vary case by case, but they will create more communication between agents, and that's a good thing. What the headlines have done is trick people into thinking that they don't need agents. A Bright MLS study asked buyers, which of these following statements do you agree with most? When buying a home, you should definitely have someone who represents your interests during the whole process. 76% of buyers agreed with that statement. The second part of this survey, and if you follow us on social media at Carrillo Group CANY, you've seen our posts and blogs about this. 91% of people agreed with it'd be very stressful to navigate the home buying process without an agent or broker. And 87% said, I believe an agent or broker is an essential trusted advisor for the home buying process.
In what is arguably a person's biggest financial decisions, I would always suggest getting professional guidance. As a seasoned and expert real estate broker, which I am, anytime I've purchased or sold real estate or property, I've used a broker. A broker is a representative in many ways. We suggest interviewing at least 3 agents. Now let's talk about inventory. And the question on the table is, will inventory improve in time for the spring housing market? And why do we care about inventory? Because more inventory should soften values, which is good for buyers. On the surface, homeowners watching may not like the sound of that, but a slight easing, not a drop in appreciation, benefits them too. Let's start with Realtor.com. The inventory of homes actively for sale nationally increased in 45 of 50 of the largest cities compared to last year. And in 4 large cities, inventory was above pre-pandemic levels. So we're seeing active inventory growing. And if you look at the overall change year over year, that's March 2023 to March 2024, you see the national average 23.5% growth in inventory. In California, it's 10.9% growth in inventory. In the Inland Empire, it's about 8% growth in inventory. And more inventory is certainly a good thing for home buyers. However, remember that real estate is local. In San Bernardino, we're experiencing the opposite. A contraction in inventory from a year ago. That's a 4.5% decline. And that correlates with an increase in sales transactions year over year, which is 9% in San Bernardino. And it perhaps shows a softening on values as year over year appreciation in San Bernardino in March was 2% compared to 10% in February and 7% in January, right? So it's still, though, very much a seller's market.
Something that has impacted inventory beyond the actual shortage of housing, and that is probably one of the biggest topics over the last several weeks, and certainly here in April, is the topic of mortgage rates. The instability of the market and all these economic indicators from unemployment to inflation to things that influence the economy affecting mortgage rates. And there are a couple of things to consider there. One, what is the Federal Reserve going to do? And what does it mean for mortgage rates and affordability? Howard Wallace of NerdWallet said this: the Federal Reserve influences mortgage rates but doesn't set them. Mortgage rates are influenced by many elements, including inflation, job creation, and the economy. The Fed's actions will be a greater indicator of what's happening in the economy. Forbes said this, in summary, that the current expectations are that the Fed will cut rates this summer.
Nobody knows for a fact what the Fed is going to do, and even the experts are sort of grasping at straws. Fannie Mae, MBA, and NAR from quarter 1 through quarter 4 of this year all show downward trending interest rates, assuming, of course, that the Federal Reserve cuts the federal funds rate, which we certainly want to see. But they're already not right about the interest rates. As of this recording, April 12th, 30-year rates were at 7.7%. If you look at this demand based on rate environment chart at 7%, there is weak housing demand, meaning folks aren't looking to buy. If rates get down to 6.5%, that's where we see an increase in demand. But even if the Fed cuts rates, those 3%, 4%, 5% interest rates are not coming back anytime soon. With today's rates, if we go from 7.7% down to 7%, what that means on a $400,000 loan is that, again, all things being considered, that difference is about $200 more per month at 7.7 than at 7%, and about $300 per month over a 6.5% interest payment. And so while $200 and $300 is certainly nothing to sneeze at, it's not a number that should hold you back from home ownership if you're ready to buy today, especially with all the programs that are available today. And we already know that if rates get down to 7% and down even a 6.5%, more buyers will come into the market, right? We already showed that at 6.5, the demand will go up. And so with higher demand means higher values. At just 5% increase in value, the difference between that rate of 7.7 to 7% to even 6.5% is a lot smaller. It was down $60. So we work with lenders, and it's happening right now throughout, that will do a one-time, no-cost rate adjustment should rates drop later on. So you can get in right now, even if it's at the 7.5, 7.7, get in, and when rates drop, you can opt out for a lower rate.
We all want to see a little bit of relief on rates. And until then, there are many programs and initiatives to help ease some of that burden, to make home ownership more affordable. Maybe you've been told you can't afford a home. Our job is to provide access via tools and resources, because the reality is that housing is unaffordable, and more so today than ever before. If you're in the healthcare field, a civic employee, a first responder, military, active or not, consider the Neighbor Next Door program, and you don't have to be a first-time homebuyer. Look at this graphic from NAR on the Housing Affordability Index. The higher the index, the more affordable the home is. The lower the index, the less affordable a home is. Homes by that measurement are less affordable today than any time going all the way back to 1990. That is a fact, and that is the truth. Look at the last 12 or so years coming out of 2008. Those are the orange bars over there, the years when distressed properties dominated the market. We've been in a time of historic affordability, and now we've seen the fastest rise in the 30-year fixed mortgage rate and the least affordable time.
However, there is some reprieve, we hope. Affordability is impacted by three things: wages, what people are earning, mortgage rates, and home prices. Let's look at wages. They're climbing at a faster pace than they have been previously. This graphic goes all the way back to 2006 and shows the trajectory from the Fed of weekly wages. And you see there's this sort of growth from the trend line there in wages. People are earning more money. And we know that. We see the employment news and economic news. People are earning more up and down the entire line. I think a sector that I hope there'll be a study on is working teenagers. For example, when I was growing up and living under my mom's roof, my job earnings mostly went to her. Teenagers today are employed in the fast food industry where they'll be making $20 an hour. And to me, that's a legit contribution that can be worked out to help the family afford a place. The second thing impacting affordability, as we mentioned already, mortgage rates. And they appear to be heading downward, whether it's $50 or $200 of savings per month. A savings is a savings. And that leaves us with home prices or home values. Generally, over time, we know that real estate or home values appreciate. What buyers don't want to see, what we don't want to see in general, are the accelerated value appreciation that we saw during the pandemic. Look at the 2024 home price forecast right here from the 7 agencies that we follow that forecast home prices this year. We see a generally 3.5% increase or appreciation on the average. Of course, real estate is local, and I'd say that throughout the Inland Empire, I expect to see 7 to 10% appreciation year over year. In San Bernardino, I expect to also see a 7 to 10% year over year. But that's when you zoom in on the neighborhood level, it'll be higher in some places and lower in others. But that sort of steady appreciation, that helps keeps things somewhat affordable and helps us at least, or folks, plan for what's to come.
But still, the reality is it's not cheap. And I know renters wonder if it's cheaper to rent a home. In some markets, it is. Realtor.com said this: among the top considerations are the financing costs and the benefits of renting versus owning. And one approach is to compare the monthly cost of renting a home against buying a home. With such cost comparisons, we can identify whether the market favors renting or buying. This is particularly important given today's landscape marked by elevated rates and still high home prices, posing substantial challenges for would-be homeowners. The February 2024 rental report from Realtor.com and NAR shows the median asking rent in the 50 largest metros. Overall, $1,700 average rental price. We'll put up San Bernardino numbers in a moment. But looking at this chart, you can say on paper each month it's cheaper to rent an apartment than go out and pay a mortgage payment. And you'd be factually correct. In San Bernardino County, the average mortgage payment is $2,664, and that could fit a 3-bedroom. Whereas the average rent, according to different sources, is about $2,300. And that may not include private houses. Again, though, renting is cheaper technically.
However, that's a short-term outlook. You know that renting is literally you helping pay the owner's mortgage. And aside from the roof over your head, which of course is critical, you don't get a financial benefit like homeowners do. If you bought a home right now, you'd feel some pain on a monthly basis. But what happens over the next 5 years? We did a video on this. Check it out on our social media at Carrillo Group CANY. Based on the appreciation that's being forecast in the home price expectation survey, we're using those very conservative estimates instead of the San Bernardino expectations. The average priced home in this country stands to gain a little over $83,000 in equity over the next 5 years. So would it be worth paying a few extra dollars per month, even if it's a couple of $100, to buy a home where you're gaining equity on it, right? And of course, we're not taking into consideration, or you have to take into consideration, I have that extra money, but let's assume that you do. Somebody says, okay, I can afford the extra $360 in my budget to go out and buy a home. What does that look like? We do the math. The equity or appreciation is $83,000. That's what you stand to gain by buying a home today in the very average scenario. If we take 5 years of payments, we're going to call it that extra bit of payment because that assumes that you're going to have to pay either in rent or when you buy. You still stand to gain over $50,000 buying a home versus renting. And that's not including the forced savings. If you go back to the video we made, you'll see how the equity is actually over $100,000 because part of your payment towards a home goes towards. So you see how the equity is actually over $100,000 because part of your payment goes towards the home, something you do not get with renting. So is it really cheaper to go out and rent? In the end, it's going to cost you.
Lastly, for homeowners, what does this all mean for you? It means you're in a great position in this market. I'm working my way to becoming a homeowner, but depending on how long you've owned your home, there are several things you can use to your advantage. First and foremost, you've gained and are gaining equity just about every single month. You can tap into that equity to build generational wealth. You can sell to maximize the equity, whether you want to downsize or upsize. You can refinance to pull out equity to purchase commercial property. That's cash flowing property. You could use to build an ADU for rental income or for extra space, and you can start a business. You can make improvements to your home to get it ready to sell for a higher price. Those are all things that will add value and provide cash flow. At CGX, we have a residential program to help homeowners leverage their homes to purchase commercial property.
Here in the Inland Empire, especially San Bernardino, home ownership will be critical. With all the great stuff happening in our region, ownership is key to not being displaced when gentrification hits, and it's already hit. Yvette and I help renters become homeowners, especially through the Next Door program. Check the details below. We help homeowners leverage their homes to purchase cash flow commercial property through our residential program. Check the details below. And we help small business owners find space to lease and buy.
All right, folks, that's a wrap. Thank you for your time. We hope that was informative, educational, and inspirational. DM us, call, or email to take advantage of our $2,000 down payment gift for qualifying buyers. We are Carrillo Group CNY, where we do real estate with purpose.
Real estate with purpose. Peace.